webinar on why you should be excited about the climate private equity opportunity. We're going to be talking about the climate private equity opportunity. So we'll start with understanding what is climate technology, what is the scope of climate tech, why do we feel that the moment is now to invest in climate investing, what drives this momentum. We'll talk a little bit about a couple of case studies of particular climate tech companies to understand how they have been developing also in terms of valuation. We'll talk a little bit about what we do at Carbon Equity and how we select funds and how we think about selecting what makes a great climate fund, what makes a great private equity investment. And we'll briefly talk about open opportunities today, which are open on the Carbon Equity platform. So prior to going there, let me briefly introduce Carbon Equity and my fellow speakers today. So for the people who are tuning into a Carbon Equity webinar for the first time, or for whose first introduction with Carbon Equity is today, Carbon Equity is a fintech platform that connects next generation wealth to the world's most impactful investing opportunities. And specifically, we enable small ticket access to the world's best impact private equity funds, currently with 100% focus on climate private equity, hence our webinar today. I see I'm missing a slide. There. Okay. So prior to diving into the content, would love to introduce the team who is going to present today. So my personal background, I have been an investor for a part of my career, or half of my career. I started my career with Hall Investments in private equity. More recently, I was a partner with Peak Capital, which is a early stage seed and Series A tech investing firm. We invest in SaaS and marketplace models. The other half of my career, I've been building companies. In my early student days, I built the Kleine Consultant, and later spent 6 years in Asia almost, where I built one of the big rocket internet companies, the largest online real estate platform of Southeast Asia, and I led a large fintech company in Southeast Asia as well as a CEO. Wiebe, would you like to briefly introduce yourself?
Sure. Welcome, everyone. My name is Wiebe Visser, and I'm a managing director on the investment team of Carbon Equity. I joined Carbon Equity last year from Opinvest, which is one of the largest private equity investors globally and part of the Carlyle Group. I spent there 11 years, focusing mainly on mid-market and large buyout private equity funds in Europe. And prior to Opinvest, I was with JP Morgan in London for well over 5 years, too long.
Cool. And Bas?
Well, a bit of a similar background as Wiebe, so I'll keep it short, but I joined Carbon Equity earlier this year as the investment manager. And before Carbon Equity, I also spent over 6 years at Opinvest, so I was in the primary investment team. So I did a lot of fund selection in Europe, so mainly buyout and VC investments. So a lot of relevant experience for what we do now, but obviously we're looking at way more interesting funds today. So
yeah,
happy
exactly.
to be here, and thanks all for joining.
Yeah, that does get me interested in the question why you are excited about climate private equity, having come from Opinvest, which is basically the Champions League of fund investing in the Netherlands, or perhaps even in Europe, and why you personally are excited about climate private equity. Before I ask that question, I would love to ask that question to the audience. So why are you excited about the climate private equity opportunity? So 10 seconds to answer. Is it because of true climate impact? Is it because the potential for outsized financial returns, climate as a growth market? Is it because you want to be diversifying within your portfolio? Or are there other reasons which might excite you about the climate private equity opportunity? Okay, there are no wrong answers here. It's okay. I'm seeing a very climate motivated audience. All right, 5 more seconds to answer. All right, thank you very much for your responses. I'm seeing an extremely climate engaged audience here, which is great to see. So a vast majority of people are interested in true climate impact, which is one of our key theses, that you can have a lot more direct and larger impact in private markets and in public markets, as we discussed in the previous webinar. but also, of course, a potential for outsized financial returns. Cool. And Bas and Wiebe, what is your personal take? Bas, what gets you particularly excited about climate private equity?
Well, obviously the impact part is very important, but to be honest, also relatively early in my career to spend a big chunk of my time on such a growth market, this is really where I want to spend the rest of my time for the foreseeable future in my career, right? We're still at the beginning of this immensely cool growth market with such cool innovative companies. It's really where I want to spend my career, but on a personal level, I do think that doing good with your money is also obviously extremely important. So it's actually a combination of both topics that got me very excited.
And Wiebe, what gets you most excited about climate private equity?
Yeah, no, well, a good question. Most excited is the impact part for me. So I'm a father of two young boys, aged 5 and 7 years old. And the oldest one started asking questions. So what are you actually doing for the climate? And that makes you think, right? So for me, climate tech and actually carbon equity in itself, there it all comes together. So it's fund investing and having impact and doing good for the planet. So yeah, I'm just trying to end up on the right side of history.
Cool. All right, let's dive right in. So the first starting point for this discussion is, what is climate technology? And there are 3 key points that I want to land. First, that the climate challenge and the resulting need for innovation is one of the biggest macroeconomic trends for the foreseeable future. Obviously, carbon emissions have been rising through the roof, as we see in this chart, and the pace of global warming and the pace of carbon emissions rising is actually accelerating rather than decelerating. So the direction of travel is one way. The problem will only grow more urgent as we progress and climate change becomes a more pressing problem. The second key point is that there is reason for optimism. If you look at the pace of decarbonization, especially of Western economies, what you see is that Western economies have been able to lower the carbon intensity of their economies quite significantly. Here you see an example of the Swedish economy, who have been able to increase GDP whilst lowering consumption-based carbon emissions and production-based carbon emissions. So there's reason for optimism as we progress through investments in technology and infrastructure. Countries are able to decarbonize. The question is, how fast can we do this, and can we do this fast enough? So it's really about speed versus ability to do so. The third point is that climate technology is all-encompassing. So climate technology is basically any technology that is explicitly focused on reducing GHG, so greenhouse gas emissions, or addressing the impacts of global warming. So think about climate adaptation technology. Ultimately, carbon and greenhouse gas emissions arise in every single sector and basically in every single industry vertical. So that's one of the key differences between the clean tech 1.0 revolution, which was very much focused on purely energy. The climate tech revolution is really focused on every single vertical of industry. And so there are 5 main sectors that contribute to greenhouse gas emissions. The first obviously is how we generate energy and also how we store that energy and electricity. So one of the key mandates of the net zero revolution is to electrify everything, to make sure that everything is electric, and to make sure that we generate our energy and electricity from clean energy sources. The second key challenge is how we get around. So think of mobility, but also airplanes. Shipping is a huge challenge to decarbonize. So mobility is responsible for approximately 14% of global greenhouse gas emissions. The third thing, and probably the hardest thing, is how we make things. So think of decarbonization of cement, decarbonization of steel. This is typically where still the biggest challenges are to really get rid of our fossil fuel addiction, and very hard to decarbonize processes. The fourth is how we live. So how do we electrify, but also heat and cool our buildings? The fifth is how we grow food and how we consume this. So food and agriculture is responsible for approximately 24% of greenhouse gas emissions. So to dive a little bit further into the underlying problems and how this results in massive opportunities for innovation and technological innovation, perhaps interesting to do one case study on agro-food. So if you look at the agro-food value chain, it's responsible globally for 24% of greenhouse gas emissions. So that's carbon, but it's also methane, it's also nitrous oxide, and a couple of other greenhouse gas emissions. And if we break that huge problem down into subsets, then you see that there are 4 key drivers of greenhouse gas emissions within the agro-food value chain. The first is land use. So think of deforestation to clear land for agricultural use, or for example, for livestock. So that's responsible for over 24% of global, 24% of the agro-food emissions. Another 27% of emissions result from crop production. And these emissions primarily result from agricultural machinery. So think of, for example, tractors, heavy machinery, but also, for example, the use of nitrous oxide fertilizer, which is a major problem in terms of greenhouse gas emissions. 31%, so the largest share of agro-food emissions, result from livestock. And then particularly cows are a big part of the problem. So cows, because of their digestive processes, emit methane, and methane has a much stronger heating potential than carbon. So very big problem. And then a further share of the emissions result from the supply chain. So how do we process, package, and ultimately transport food from the farm to table? And so all of these sub-problems create a huge opportunity for innovation, where there's great sense of urgency to innovate. And so you see a couple of clusters of tech innovation emerging. So if you zoom in on the agro-food space, for example, one of the key innovations trying to address land use is vertical farming. So making sure that we use significantly less land to produce much more produce. And also making sure that the produce is much closer to the consumer, so it's even healthier. So less land use, fewer carbon emission, and healthier food. And that is creating a market that is projected to be over $10 billion US by 2026. And so some really cool companies that are leading the charge here. So companies such as Infarm, Bowery, Aero Farms, and Plenty are all building vertical farms. Infarm is part of the Optimism Ventures portfolio, which is one of the funds that is currently on carbon equity. It's already a unicorn, super cool vertical farming company from Berlin. A second swath of climate tech companies is addressing the crop production emissions. So these are companies that are, for example, trying to reduce emissions from agricultural machinery or from fertilizer use. So one of these companies is, for example, Monarch. They create electric tractors, which is also part of the Optimism Ventures 1 portfolio. Or the company Nutricity, and I'll show a brief video on this company, which is a super awesome company that is revolutionizing fertilizer. And they are part of the Energy Impact Partners portfolio, which is part of the decarbonization, the Carbon Equity Decarbonization Fund. A third group of climate tech companies is trying to address the emissions from livestock and fish farms, and primarily through the use of alternative proteins. And you see 2 big strands in terms of alternative proteins. One is trying to address the emissions for plant-based proteins, And another is addressing this through cell-based proteins. So for example, here are two examples of Dutch-founded companies. The company Plantable, they use duckweed as a plant-based protein for human-grade consumption. And the company Meatable, Dutch company as well, are working on cell-based meat innovations. And a fourth group of companies addressing agro-food emissions, they focus on the supply chain emissions. And one of the major contributors to supply chain emissions is food waste. So companies such as Appeal Sciences, also part of the Ostener Ventures One portfolio, they have developed a biological coating for fruit and vegetables, which increase the shelf life of these fruits and vegetables, which lead to much less food waste and save plastic pollution. But also companies such as Too Good To Go make sure that we waste less food. So some really cool innovations within the agro-food space. So here you see how a huge problem gives rise to a ton of innovation. And here's one brief video of a company that we think is very, very cool, which is working on fertilizer.
When you see a lightning storm pass through an area, the next day you'll notice that the plants will be really green. And that's because lightning breaks down the nitrogen in the air, and rainwater brings it to the soil as nitrate. This is natural fertilizer. Nitricity has figured out a way to artificially make our own lightning to create the cleanest, most efficient, the least carbon reliant fertilizer on Earth. This is revolutionary technology. We could only support about a third of our current global population without the synthetic production of nitrogen fertilizer. As a species, we need this to live. The problem is, the way we make it now is really bad for the environment. Conventional fertilizers contribute to climate change through all steps. These fertilizers are produced hundreds or thousands of miles away from the farmers that need it in a process that uses coal or natural gas. For every 1 pound of fertilizer put into the soil today, as many as 8 pounds of carbon dioxide equivalent emissions are released into the sky. And the big kicker is that the fertilizers getting to farms are not those that are best for farmers in their fields. They're strongly optimized instead for factories and freight. Nitricity produces fertilizer fundamentally differently than has ever been done before. We use just air, water, and renewable electricity. We're installing an extension to an irrigation pump in a shipping container, and in that container, it takes electricity from an adjacent solar array, containerizes lightning, and we use that to produce fixed nitrogen in solution with water, and then inject it into existing irrigation systems. With our lightning fertilizer, a tiny fraction of a pound of carbon dioxide equivalent emissions is all that's left. We profoundly decarbonize the process. We care about working with farmers. We enjoy being on farms and developing something that produces fertilizer where it is needed and in the forms and the type that is needed, and discovering what that.
Yeah, so that gives a little bit of a feel for what these companies are working on and the size of the opportunity particularly. Cool. Wiebe, I'd love to pass it on to you to discuss why we feel that investing in climate technology currently is particularly exciting.
Yes, thank you, Jacqueline. So in this section, I'll spend time on why we believe private markets is also the best place to invest in climate tech and why it's a unique opportunity.
Right.
So starting with why private markets. If you can go back, yeah. Well, first of all, the vast majority of companies is private, which means they're not listed on the public stock exchange. And this number is actually increasing. So if you look at the number of companies that was listed in the past 20 years, this has dropped by 50%. So companies prefer to stay private longer. And that means that nowadays, in order to gain access to the most interesting opportunities, you have to invest in the private markets through private market funds. Now, secondly, the impact of every euro or dollar you invest is significantly higher in private markets than if you would invest, for example, in an ESG stock on the public markets. And the reason is as follows. Most climate tech companies are still early on in their life cycle, and almost every euro that is being invested via venture capital funds or growth funds in this space goes directly into the company in support of technological developments, building new plants or expanding into new markets, Whereas if you buy shares in an ESG tracker or an ESG stock on the public stock exchange, your euro goes straight to the selling shareholder and hardly anything goes into the company. And then finally, the returns achieved by private markets funds have, on average, historically outperformed public markets by a wide margin. So to sum up, private markets offer a larger opportunity with more attractive impact and return potential. Well, diving a bit deeper into the risk-return profile of private market investing, historically, investors in private equity and venture capital have been able to significantly outperform public markets, but only if you select and get access to the right funds. That's critical. So this chart shows the average yearly return over a 10-year period for, on the left-hand side, US and non-US public market funds, and on the right-hand side for private equity and venture capital private market funds. Now, the key takeaway is that the top 50% of private equity and venture capital funds have returned on average between 15 to 45% yearly returns, whereas public market funds only returned 5 to 15% on average. So there's a clear outperformance potential if you invest in private markets. On the flip side, the weaker performing private equity and venture capital funds have underperformed. So it's critical that you select the right funds and get access to the right funds. I think that's really a point I want to stress here.
Wiebe, there's one question coming in from the audience. How does carbon equity as a relatively new investor secure access to the most sought after funds?
Yeah, and that's exciting. That obviously that was one of the key questions we had ourselves as well. Can we get access into the most promising, most experienced fund managers? And the answer is yes. So our story is very well, resonates very well with all those managers. They really see what we're trying to do, that we're addressing an issue as carbon equity, and we'll get into that a bit later on, but by democratizing access to climate tech, it's something that resonates well. So we indeed have not had any instance where a manager would say, no, you can't get in. Actually, they are making room for us in certain cases. So it's comforting, but it's important. It's very important to be able to get into the right funds.
Yeah, we'll discuss this slightly more when we get to the carbon equity, what we do as a platform, and address the questions on fund manager selection. Cool.
Yep.
Thank you.
Now, within private markets, I personally strongly believe that climate tech offers a once-in-a-lifetime opportunity, both to maximize your impact, but also benefiting from the huge return potential, and that will be over a longer period of time. Now, all the stars seem to be aligning, and so what is driving this? And it's really a mix of a lot of different things. So first of all, it's the adoption of new regulatory frameworks across the globe. It's people across the globe experiencing extreme weather directly themselves. It's a realization based on recent geopolitical events that we need to become less dependent on fossil fuels. And this list goes on and on and on. And this created a unique market opportunity. First of all, you have the pull from consumers who are changing their behaviors and their willingness to pay up for more sustainable products. There's the push from governments that are committing to net zero. And lastly, but definitely not least, it's the pledge by some of the largest financial institutions and investors who represent 43 trillion of assets under management to also commit to net zero. So I think it's all these factors together enable climate technology to really become a sizable and investable opportunity. And you see it also, it's really one of the fastest growing segments within the private markets. 5 years ago, this was only still a 5 billion market opportunity. By 2020, this has grown to over 15 billion. And I think the latest data that we have, based on 2021 and especially the second half of 2021, we do estimate now the market to be 40 billion, and it's increasing. So we're only getting started. I think according to McKinsey, the funding need to decarbonize a sector like energy, for example, is 1 to 1.5 trillion per year, with a greenhouse gas reduction potential of 9.5 gigatons per year. And also for the industrial sector, for example, the annual funding need is 150 to 240 billion a year, and again with an impact potential of 7.5 gigatons per year. So those are huge market opportunities still ahead of us, right? And similar large funding needs are required for mobility, buildings, and food and agri. So the future market is really enormous. I think entering the climate tech segment early on is starting to pay off. The number of climate tech unicorns is expanding exponentially, I would say. And according to Larry Fink, the CEO of BlackRock, this will continue in the foreseeable future. He mentioned the next 1,000 unicorns will be in climate tech. And we can actually confirm that. I mean, the number of interesting investment opportunities that we see on our desk every day is extremely attractive, and those could very well become the next Tesla in the next 5 to 10 years. So it's an exciting space. So to conclude, we believe really that climate tech investing can be best done through private markets. That opportunity is just by far the largest. Also to have the most impact with your capital, but also to benefit from the huge return potential. And it's still early days, so it's definitely not too late to join us on this journey. Are there any other questions, Jacqueline, for now, or should I?
Yeah, I think there are a couple of questions on whether we invest in emerging and diverse managers, but I would propose to discuss that when we talk more about carbon equity. So
sure. Okay,
yeah.
so let me now make it a bit more tangible by walking through 2 companies that some of our relationship fund managers have invested in, starting with Form Energy. So Form Energy develops and commercializes a low-cost battery system that can store wind and solar energy for a longer duration. So this company technology transformed the electric grid by making renewable energy dispatchable year-round. And this technology was invented at MIT and is supported already by some of the most well-known climate tech investors, such as Breakthrough Energy Ventures, but also one of our relationship fund managers called Energy Impact Partners. Now, this company is only 4 years old, but if you would have had access to one of the earlier funding rounds, you would have benefited from a significant valuation uplift to close to 1 billion as of June last year. You see it here on this chart, how quickly this can go and how important it is to get in early and get that access if you want to benefit from that uplift. And it's an exciting opportunity. Now, the good news is you can get access to Form, and even still at a approximately 50% discount to the latest valuation if you would invest through our decarbonization funds, because the fund by Energy Impact Partners that invested in Form is part of our fund offering. So it's an attractive way to get exposure at a discount still. Just saying. Another similarly exciting story, which by the way is not part of any of our current fund offerings, but is part of a previous fund managed by Astanor, one of our other relationship fund managers, is a company called Appeal. So Appeal has developed a plant-based edible coating that enhances the shelf life for fruits and vegetables by approximately 2 weeks. And at the same time, it expands the range of foods available to consumers year-round, while also reducing the need for plastic packaging, like Jacqueline already earlier mentioned, and also reduces the need for pesticides or refrigeration. So overall, it's easing the environmental impact of the agricultural production. Now, since food waste contributes to approximately 8 to 10% of greenhouse gas emissions, Appeal is really offering a great solution to reduce the carbon footprint of the agri-food supply chain. So this company has so far raised approximately 700 million, and it uses that capital to scale both with suppliers, such as big farming companies and growers in Africa, South America, and Central America, as well as with retailers. And it uses the capital also to enlarge the footprint of its produced treatment facilities across the US, UK, and Europe. So it took Appeal approximately 6 years to reach a valuation of over 1 billion. And the latest investment round, which was led by Temasek, valued the company well over 2 billion. So this is just one more example of the exciting opportunities in climate tech that can be found when you invest in the private market and through private market funds.
Cool. Great. All right. One question, Wiebe, from the audience. How do you look at current valuations in climate technology?
Yeah, it's very broad. It's like you explained, the scope of climate tech, it ranges so many different industries and there's so many different niches. So it's difficult to come up with one answer. It's clear that certain areas are at a certain moment in time becoming a bit more hotter than others. We've seen that in certain verticals of the food and agri space. But in general, you could say there's still so much room to grow for any of these industries that we're not too worried about it. That's one. I think two, we invest with managers that have a deep track record, right? So they have been investing through the cycles. They have been able to maneuver times where certain markets became too hot and then switch to other more attractively valued segments. So if you back the right managers, and if you diversify the portfolio sufficiently that you don't go after a particular industry, then I think you should be right.
Okay, cool. Thank you. All right, Bas, would you like to give a bit of an overview of how we as Carbon Equity think about fund selection?
Yes, of course. So thanks. So we hope obviously by now you're as excited, or at least have as excited as we are about climate tech opportunities. And now you're wondering, how can I invest for this now? Well, that's where Carbon Equity actually comes in. So we're founded as an investment platform to give you this exposure. So on this slide, we show our investment team. So we're a team of 6 at the moment, really every day looking for new investment opportunities to put on our platform. Maybe highlighting 2 people who are not in the presentation today. So Lara is our Chief Investment Officer and one of the co-founders. She co-built the Philips Ventures portfolio, so over 1 billion portfolio of both venture investments, but also fund investments. And we have Lisa, one of our co-founders, and she's our Chief Impact Officer. So very important part of our due diligence process. So she spent a lot of years at McKinsey doing sustainability projects, and she's heading our impact due diligence. And maybe also quickly to highlight Dirk Meuleman, he's our external IC member, extremely valuable as he's the CEO of Phoenix Capital Group. So he guides institutional investors and consult them on impact investments. So he has tremendously good insights, and he looks at the same funds as we do. So very valuable insights. So the private equity market, as you might know, is very hard to access for private individuals. So the most fundamental issue is the minimum ticket. So most funds will require you to commit at least 5 million. So you need to be extremely wealthy, especially if you want to have a diversified portfolio, which we think is key in private markets. And what is also extremely important is network, right? The most sought after funds are invitation only. You cannot just call them. You really need to have a good network and a name in the market to get access. And then you also need to select the right funds. As we've seen before, the dispersion of returns is actually quite big in the private equity market. So really having that selection capability is key to make sure you invest in the right funds. Well, and that's where we come in, right? So we spend all our time looking at the most attractive funds and offering to our investors for actually quite small tickets. So at the moment, you can invest through us as of 100K. We expect this to go down next year to 25 or maybe 50K, which is a really unique exposure you can get to private equity markets through us. So we combine all the smaller tickets into a sizable 5 million plus ticket and invest those in the best private equity funds out there in the climate tech space. And we make it a very easy process as well for you through our platform. But what is probably even more exciting is that we can also offer you a portfolio of funds. So for that same 100K plus ticket, we can give you a diversified exposure to 5 to 7 funds and over 100 companies and beneath these funds, which is really unique. You cannot get that anywhere else at the moment in climate tech. And really, we're looking for funds that drive impact and strong returns. And we make it actually a fun and interesting journey as well. So we really try to take our investors alongside the journey. So we show the companies we're investing in. We host webinars where you can meet the managers. So it's not a boring and static investment, but we really try to make this a bit more fun, as it should be. And yeah, we offer you a diversified portfolio right off the bat, which is a great way to get started because diversification is really key in private markets.
Yeah, I would like to stress that if you just start investing and don't have any exposure to private markets, then the portfolio fund is the right place to start, in my mind. Especially for the diversification reason, and that reduces the risk. So it's.
So we'll dive a bit deeper in the portfolio fund later, but maybe one step back. So how do we find these funds? Well, the good news is it's a very broad market, and it continues to grow. Like every day we see new funds coming up. So we're currently tracking over 700 funds across growth equity, venture capital, Europe, US, different climate verticals. So there is a lot. The honest answer as well is it's an emerging market, right? So there definitely are funds out there with a decade plus of experience in climate tech investing. But there are a lot of new funds as well. We see generalist GPs raising separate impact or climate funds, but we also see a lot of new funds where you see teams, people teaming up with a lot of venture capital experience, combining that with people who come out of the clean energy sector. So there is a lot of interesting opportunities. And as we've said, emerging market really offers the opportunity for outsized returns, but it's definitely key to have the fund selection skills here because there is a lot to choose from and there's a lot of early stuff. So it's really important to pay attention to fund selection, like committing to the 12 fund of CVC or index ventures. Everyone can do that, but we're really looking for the best funds out there. So how do we do that? We create a funnel. Maybe we can.
Oh, sorry.
We can go. Yeah, thanks. So we really just funnel it down, right? So we look at the funds that are open for new capital the next 12 months. We shortlist them, and we really look for strong impact potential and strong returns. And then we go into full due diligence. And then finally, if we come out positive, we obviously approve the funds and invest in them. So for the portfolio fund, we've approved 2 funds, and we'll dive into those later in a bit more detail. So how does our process look like? How do we diligence these funds? So there are 2 processes to it. So the first is the general due diligence, which you would expect from any high quality fund investor. So this is what Wiebe and I have been doing for years at AlpInvest. You really look at team, strategy, organization, the terms, track record. Is this an attractive investment? But what sets carbon equity apart is our impact diligence. This is a very fundamental part of our due diligence, and it really needs to pass before we move on with our general due diligence. So what we found by looking at multiple funds is that intentionality is actually the key driver if a fund will reach material impact or not. And we assess that through 5 different categories. So the first and most important one is the impact mandate. Does the mandate really embed impact as well? If it's not really part of the mandate, we're not going to invest with the fund. It's a deal breaker for us. Then there are 4 other categories where we would like to see at least 1, but preferably 2 passes as well. And the first one is an impact goal. So what does the fund want to achieve in terms of impact? Is there a fund level goal or portfolio goal? Or we also see funds who say, per 100 million we invest, we want to achieve this kind of reduction potential. This is very important to us. We also look at the incentive structure. So private equity is known for having a performance fee, or also called carried interest, which is normally only tied to achieving financial returns. But the funds we look at are generally also tying those returns partially to achieving their impact goals, which is also very important for us. Then we also look at sourcing, probably maybe the most important part of our due diligence process, really understanding how do they source deals. And maybe just to give you an example to what we look for. So 2150 is what urban fund we invested in. And the way they look at sourcing, so they look at key problems. So the concrete market, globally responsible for almost 8% of emissions, very big problem. How can we solve that problem? Which technologies are out there to get concrete to a net zero market? Which technologies do we think are most feasible to be able to deploy at scale? And then within those technologies, what companies do we think on a global base are the best ones to invest? That's the type of sourcing we're looking for. And then lastly, also very important, some kind of a threshold. We're not looking for companies to have just a net positive impact. We want material impact. So we're looking for some kind of minimum impact threshold for an investment to pass. So if we believe the intentionality is there, we'll dive deep. So we do our full impact diligence process, and this is quite cool actually. So this is a totally new market. Like there's no market standard yet how to do your climate impact due diligence, and Lisa actually came up with a very clever and thorough process, which eventually ends up at this scorecard. So, and well, I probably need 30 minutes to give enough attention and respect to the model she created. And we'll host future webinars where Lisa will really dive deep. But just to summarize a few points. So the mandate I already discussed on the prior slide. So the organization, this is very important for us. We really look at the climate expertise. So does the manager really understand what gets to net zero? It sounds very easy, but it's actually quite complicated. So we really try to assess the level of knowledge within the firm, and also who in the firm is really owning the impact strategy and how embedded is that in the process. Let me see. So selection, we already briefly touched upon. So maybe the one thing I want to end this with, so the action so far, the last bullet, it's actually quite subjective, but it turns out to be a major driver for us. Really see what are the actions so far by the manager. So we go through the portfolio, we go through the pipeline. Do we get excited from these investments and not from a return potential? Obviously, we also need to be excited about that part, but really from an impact potential. Are these investments, are they going to move the needle? Is this really what they said they will be doing? Yeah, very important for us. So yeah, maybe let me pause here for a minute. Jacqueline, if there are any questions?
There are. So one of the big questions is, as you mentioned, it's a relatively new market and there are a lot of new funds. What is your view on backing first-time or emerging teams?
Yeah, well, that's on top of our mind every day. So we cannot get around it. There's so many very interesting new opportunities out there that we definitely look at them. And what's really important for us is it doesn't feel like a new fund, right? So it can be a newly formed GP, but what we're looking for, have these people invested together before? Do they know each other, or are it just a couple of people coming together for the opportunity? Have they already made some investment in the fund, or like going through the pipeline, really understanding what they're doing? So what we normally see also with first-time funds, they don't get raised in 2 months. We have more time, and we can see the first investment being made, assess them, and we do a lot of references in the market, on their network, on their prior track record. So we do first-time funds or emerging managers looking at the second fund, but it will just require a bit more work to get comfortable. But yeah, the return potential with emerging managers can also be very attractive. So we do look at it, and we try to balance it out in our portfolio, right? So that there are more proven managers who are investing their third or fourth fund, and we also look at some of the more emerging managers. And that's also why diversification is just very important. You cannot just put your money on one manager, and that's why the portfolio fund will invest in 5 to 7 managers to balance out the risk a bit.
Yeah, cool. Is diversity a factor that you look at in the investments in the GP teams? For sure.
So it's not a requirement to invest into a fund that it needs to be a diverse team, but I think science has proven, research has proven over and over again that diverse teams make better investment decisions. Mm-hmm. So it's definitely something we look at, and we see in the most funds we're actually looking at that they're quite diverse teams. But as said, it's not a requirement for us to make an investment.
Cool. Thank you. All right, let's proceed.
So maybe spending a few more minutes on the open investment opportunities, and then we can open it for the final Q&A. So that our main fund currently open is the Decarbonization Fund 1. Maybe we can go to the next. Yeah, great, thanks. So this is the portfolio fund we've mentioned before. So we expect 5 to 7 funds to be part of this portfolio. So there will be approximately 100 plus companies. So it's a very well diversified fund, really from early stage seed investment up until some later stage growth investments. There will be European funds in there, US funds, across different industries. So yeah, it should be a really well diversified portfolio, which is a great way to get started. So it's a 25 million target fund. We just had our first close a month earlier, already at 15 million. So we're a good way ahead. So we expect to reach our target over the coming months. It's not a full blind pool anymore. So you have some visibility already. We committed to 2 funds already. So we've deployed approximately 10 million already. And maybe let me just spend a few minutes on those funds so you can see what actually is part of their portfolio. So the first one is the Deep Decarbonization Frontier Fund 1. We're extremely excited about this one. So it's a US platform. So this is also a nice example where we backed a first-time fund, but it's part of a way bigger platform. So Energy Impact Partners is a 2 billion platform really focused on private markets getting to a sustainable energy future. So this fund tremendous benefits a lot from the platform in terms of sourcing, in terms of knowledge, in terms of exposure. And that's what we see so far already. So they've made 8 investments already out of the fund. Form Energy, as we discussed, is in the fund. And yeah, already tracking north of 2x, and you can get in at cost through us. So very interesting. Nutricity, the video Jacqueline showed earlier. So there are a lot of very interesting investments already in the fund. So it's not a blind pool anymore. And yeah, we just feel very excited about this one, where it's early investment in hard to decarbonize problems. So it's really investment that will move the needle down the road if they get it right. The second investment we've made is in Astanor. So this is a Belgian fund, but they have offices around the globe, really focused on agri-food tech solutions. So they just finished investing their first fund, and out of 30 investments, they already have 3 unicorns in the portfolio, which really speaks volume about the selection skills of management and really the network they have. The team consists of, so this is also a typical new-ish manager in the space. So it's a combination of real professional VC investors. So the ex-founders of Benchmark Capital set this up with other partners who have a lot of deep experience in the agri-food sector. And yeah, it's really starting to pay off. Fund 1 looks very good. So Appeal, the company Wiebe discussed, is here in the portfolio, but also Infarm we touched upon earlier, and also Insect, this company you might know, where they try to make proteins out of insects. So we see a lot of very interesting companies in Fund 1, and we are expecting the same for Fund 2. So very excited about this one. So the fund is both in our fund of funds, but we also have this separately on our website as a single fund. So if you want to get exposure or additional exposure to the agri-food sector, you can also directly invest into Astanor through our platform. And maybe then to spend a minute on our, so we have a very deep pipeline. We expect over the coming weeks to approve 1 to 3 more funds. And one of that is Arcton Ventures Fund 3. So this is a manager with a lot of experience in the market. So they're focused on Earth Tech Venture, which sounds very, very cool. And but it's basically what you would expect from a climate tech fund. So the majority they do in the energy sector, industry sector, but it's also a bit broader. So there is some agri-food in there, or some of the more nature investments, but it's 90% plus focused on reducing greenhouse gas emissions. So they're based in Canada, but primarily focused on North America. The fund 2 is tracking extremely well, so it's already held despite relatively young vintage at over 2 times and 45% net IRR. And some companies in the prior fund are Mosa Meat, you might are familiar with. So they try to make a meat burger out of cells, but also Palmetto is a very famous investment from them in the US, which is a marketplace to get renewable energy. So if you want solar panels on your roof, you can get that through Palmetto. So we still we're in the final stages of our due diligence. So the jury is still out there, but we expect this one to end in our portfolio over the coming weeks. Maybe if you're super excited by now, you want to get access, feel free to go to our platform. So you can get access to the data room where we provide more information, and you can always send us an email or schedule a call where we can give you somewhat more details. maybe one thing I forgot to mention for the Astana fund, so we're almost sold out on these single funds. So if you want to get access to Astana Ventures Fund 2, well, you might need to hurry up a bit because we're almost sold out. Yeah, maybe pausing here for a second, Jacqueline, if there are any questions or.
Yes, yeah, that's basically the key presentation, open to questions, and there are already a couple of questions. So one question is, can you please clarify the investment economics from an investor point of view when you have a chance? Wiebe, what could you say about investor economics? That's a bit of a broad question, but.
Well, for private markets, I think it's pretty standard. So what you pay to get access to these type of funds typically is a 2% management fee, and if they do well and reach their financial and impact hurdles, a 20% carried interest. I mean, broadly speaking, that's the structure, which is more expensive than if you would invest in public markets. But the way we look at it is the net returns over time also make it still very attractive, right? So taking into account these type of fees, the net returns still outperform public markets. So it's not cheap, but the returns make up for that.
Yeah, great. Here's a great question. Do you apply your impact scorecard to yourself, and is it available? That's an excellent question. Yes and yes. So the impact scorecard can be found in the data room of the respective funds for every fund that we have. So it's a public scorecard. Also, there's a blog post on the website which explains the impact scorecard. And yes, we also regularly, every half year, apply this scorecard to ourselves. I think last time we scored a 3.2, which means there's room for improvement in terms of formalizing our processes. But that's definitely something that we're very critical of. So great question. There's another question. You talk about returns in terms of money, but what is the carbon impact of the investments? What can we say about that, Bas or Wiebe?
So the financial returns clearly are very easy to measure, right? And for carbon, it's more difficult. So the KPIs per company within each fund are different. We just, through our assessment, want to make sure that it's really meaningful, that there are thresholds that are met by the fund and the companies that are meaningful, and overall the potential in 5 to 10 years is significant and contributes to greenhouse gas reduction emissions. The actual reporting on that by the funds is still in the works. Different formats are being developed, but there's not one number yet that they report, and therefore it's tough yet for us to report those numbers. Clearly, this is something that we're working towards as an industry, but it's not available.
So what we report is the impact figures that funds report to us. But what we are careful with is aggregating those impact numbers, because as long as funds are not measuring, say, carbon emissions avoided in the same way, then you're counting apples and pears. So we're careful to make any sort of aggregate carbon claims. But of course, all of the underlying funds have their own impact metrics, which will be reported to all of the investors on the carbon equity platform.
Yeah, and hopefully this will standardize over time, right? I think that the industry is working towards it. So we're
exactly
advocating that.
Here's another question in the same in the same realm. So somebody asks, you mentioned impact incentives are important during impact diligence, and the hurdle for a GP's financial incentive is more or less standardized within the PE industry. That's correct, typically 8% or something. Setting hurdles for impact seems much more complex. Do you have any comments about how you ensure GP's impact targets hurdles are ambitious and reward outperformance?
Well, that's a very, very good question.
Go ahead, Bas.
So the thing we're looking, so it's very hard to assess for us what are ambitious targets, right? So we're not as close to these companies as the GP are. So what's important for us that they have a third-party validation of those targets. So we wouldn't normally see there is a special impact board at the fund level, or they use a third-party consultant that really reviews the target set and make sure they're ambitious enough. So it would, because indeed it shouldn't be too easy to reach those numbers. So that is a way we make sure they're ambitious enough.
Yeah, what you might also stress is that you see quite a range of impact targets. So some funds do not set impact targets in terms of carry. Others have, say, 50% is dependent on achieving the impact goals. And what you will typically see is that a fund will set impact goals for an investment prior to the investment, and their carry will be dependent on achieving those impact goals. You also see in some extreme scenarios, such as with the Just Climate Fund, which is available through Carbon Equity, but not yet live on the website. This is the latest fund of Al Gore, that they have 100% impact incentive. So they're 100% rewarded for emissions avoided towards 2030 goals. So that's the most extreme scenario that we've seen. One other question, can you elaborate on the terminologies of green, clean, climate, and earth tech? That's a very good question. What is the difference between climate and earth tech, for example, in the case of Arcton, Bas?
Well,
the same names for the same banana.
There are a lot of names flying around, right?
Yeah.
So yes. In the end, it's kind of the same. Like what we're looking for is climate tech investing, and we are focused on decarbonization at the moment. And there are some areas, and especially Arcton also looks at. So, for instance, they have an investment called ShareTags in their portfolio, which makes pantyhoses, which you won't throw away after 2 times usage. And so it's very good for the earth, but it's not what we really define as climate tech at the moment.
Yeah, exactly. Cool. All right, time is up. Thank you so much for attending today. I imagine that a lot of questions have not yet been answered. Do feel free to reach out through email. Here's my email, phone number. You can reach us through the chat function on the Carbon Equity website. Do feel free to send us an email, jump on a call, and explore the Carbon Equity data rooms. We hope to welcome you in our funds and at future webinars. So thank you very much for attending, and see you next time.